Welcome back to the channel. This is the Socialist Report. We got this from the World Socialist website. Bank of Japan decision sends shock through global markets. Don't know why I'm wearing headphones, but let's get right into it. The Bank of Japan has delivered what was almost universally described in the financial press as a shock to global markets with its decision on Tuesday to relax its so-called yield curve control policy. Under the policy implemented almost a decade ago, the central bank was intervened in the market, buying up government bonds to ensure that the yield or interest rate on 10-year government debt hovers around zero. The loosening move was a decision to expand the band within which the yield can fluctuate from minus 0.25% to plus 0.25% to minus 0.5% to plus 0.5%. Bond prices fell in response to the decision, sending the yield to as high as 0.47% before easing back to 0.41%, the highest level in almost 2 decades. Bond prices and their yields move in opposite directions. While the numbers involved are small, the implications are large because of the trillions of dollars that surge through the global financial system every day. Thus, a small movement in interest rates can result in sizable gains or losses on any deal depending on the calculations made when it was struck. A number of financial trading houses had been making the bet there would be some move on the YCC policy, if not its total abandonment. This was because of the pressure on the Japanese currency and financial system resulting from the interest rate rises spearheaded by the U.S. Federal Reserve and being followed by central banks around the world. The interest rate disparity between Japan and the rest of the world led to a sharp drop in the yen as it fell to a low of 150 to the dollar in October. It rose subsequently, and as a result of the loosening announcement, the exchange was 133, an upward movement of 2.9% on the day. Outlining the decision, BOJ Governor Haruhiko Kuroda denied it was monetary tightening or the abandonment of YCC. He said it was aimed at addressing volatility in global financial markets and improving the functioning of bond markets to enhance the sustainability of monetary easing. This measure is not a rate hike, he said. Adjusting the YCC does not signal the end of YCC or an exit strategy. Despite these claims, the move was seen in markets as at least a significant crack in the operation of the YCC, possibly opening the way for its eventual scrapping. Some movement had been expected, but not until the retirement of Kuroda, the architect of the policy, in April next year. We view this decision as a major surprise, as we had expected any widening of the tolerable bands to be made under the new BOJ leadership from spring next year, similar to the market. Naohiko Baba, chief Japan economist at Goldman Sachs, told the Financial Times. In a situation of rising interest rates worldwide, the BOJ YCC policy has been described by some analysts as a dysfunction. The BOJ now holds more than half of all outstanding government bonds, compared to 11.5% when Kuroda became governor in 2013. For past decade, the BOJ was carried out one of the most extreme versions of the program of quantitative easing adopted by all major central banks in response to the global financial crisis of 2008. Under the YCC policy initiated in 2015, virtually all new debt of the government, one arm of the state, was bought up in the bond market by its financial arm, the Baj. Okay, so I don't know the most when it comes to economics. Still learning about economics, but from what I'm understanding here, the Baj is a private company that is buying government bonds in form of quantitative easing, which I know is basically what capitalists do in order to avoid. You know what? I'm not 100% certain what quantitative easing is. Let me look it up because form a monetary policy in which a central bank like the U.S. Federal Reserve purchases securities from the open market to, so it's where the government buys from private companies. Form a monetary policy in which central bank purchases securities from the open market to reduce interest rates and increase the money supply. Quantitative easing creates new bank reserves, providing banks with more liquidity and encouraging lending and investment. The United States Federal Reserve implements QE policies. Quantitative easing is a form of monetary policy used by central banks to increase the domestic money supply and spur economic activity in order to reduce interest rates. Quantitative easing is typically implemented when interest rates are near zero and economic growth is stalled. The United States, blah, blah, blah. The central bank purchases government bonds and other financial instruments such as mortgage-backed securities. Risk inflation is one of the risks. Limited lending, devalued currency. The United States has a lot of devalued currency, but we're talking about Japan, which is something I really don't know too much about. Japan, the typical American, not known too much about any other country besides the United States, but that's what I've been brainwashed with, all the stuff from the United States. As a result, total Japanese public debt has risen to the equivalent of more than 260% of GDP. The Baj move did not produce major movements in financial markets apart from some marginal tightening of interest rates, but further steps in the same direction could have more significant consequences. In comments reported by the FT, Mansoor Mohiuddin, chief economist at the Bank of Singapore, said the decision was significant because it indicated the central bank was considering an exit from YCC, as he recalled a major turning point in Japanese financial history. The Baj decision to raise interest rates in December 1989 led to a major sea change in Japanese markets. One thing I know is raising interest rates is bad. It hurts the working class. I know that for a fact because the United States, that's what they're trying to do. That's what they're trying to do with the current that's how they plan to address the inflation. But raising interest rates, I guess, means that I'm going to guess that means that they raise the interest rates on banks so that they charge you more interest for loans you take out, I'm guessing. What does raising interest rates do? Higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments. Those who can't or don't want to afford the higher payments postpone projects that involve financing. Okay, so I was actually right about that, from what I understand there. He said, today's officials will be keenly aware of that history. It amplifies the significance of their signal to markets today. The 1989 decision led to the collapse of a financial bubble during which the value of the Imperial Palace in Tokyo was worth more than all the land in California. The puncturing of the bubble led to a sustained fall in the value of stocks on the Tokyo market from levels to which it has never returned. A series of comments from financial analysts reported by Bloomberg, pointed to the potential global consequences of the Baj move. According to Vishnu Varathan, a leading official at the Mizuho Bank in Singapore, the Baj has created so much tension in the markets this year with its policy stance. The spring has been so tightly wound. The impact could be massive when they finally decide to let it go. It will rip through every aspect of markets. Masumiki Adaki, a former Baj official, now chief Japan economist at UBS Securities, said the decision was a step toward an exit, whatever the Baj calls it, and opened the door for a rate hike next year. In a note to clients, Jim Reed, global head of macro research at the Deutsche Bank, wrote, "It's important not to underestimate the impact this could have because tighter Baj policy would remove one of the last global anchors that's helped to keep borrowing costs at low levels more broadly. Japanese financial interests have more than $3 trillion invested in stocks and bonds globally, with more than half of that in the U.S., chiefly in U.S. Treasury bonds. According to financial analyst Amir Anvarzadeh, an observer of Japanese markets for more than 3 decades, a decision to allow rates to rise could see a tsunami of offshore Japan money flooding back home. That is the big reset move." Naka Matsuzawa, chief strategist at the Japanese financial giant Nomura, said yield curve control is approaching an effective end if a wider trading band is the Baj way of normalizing policy. Market volatility will only rise further. Such comments illustrate the fact that central banks, which have pumped out trillions of dollars over at least the past 15 years to prevent a financial crisis, have only created the conditions for even greater financial turmoil as they attempt to normalize policy. I understand that last line quite a bit. Once again, I'm no genius when it comes to economics, still learning. But the banks have created the problem because of all the money they pump out and all the stock investments. Or maybe I don't understand it as much as I think I do, but I do want to point out why I keep doing stories that are not about the United States. This channel is to unite the working class of the world. I don't want to just do stories in the United States because there are people in the world that are suffering just as much as Americans are, or maybe even more. So I want to cover stories from all over the world. And also I've been just doing from specific sites, so yeah, it tends to lean into countries from all over the world. But the reason I actually do them is because I want to cover stuff from the working class all over the world. So that's going to conclude this video. Thank you for watching. This is from World Socialist website. Make sure you check them out, and see you in the next one. Peace. This has been the Socialist Report.